Good morning, everyone, and thank you very much to Marine Money for inviting me back to kick things off on what should be an enthralling day of presentations and debate. My topic today is today's biggest themes for shipping investment. As ever, I'm going to try and cram in quite a bit, and hopefully it will lay the groundwork for the rest of today and tomorrow. I thought I would sort of kick off things, as I'm the first speaker today, just to reflect on where the markets have been over the course of the last 12 months since I stood here 12 months ago and 1 week, I think, actually. And as you can see, pretty much across the board, we've seen strength in both earnings and values, apart from the LNG sector. Some of these changes have been significant, as we can see on the chart on the screen. They've been so significant that actually for some sectors we're now at sort of recent record highs. The bars on the chart here just show you the highest one-year TC rate we've seen since 2010. The green dots show you where today's earnings are in relation to the 2010 historical highs. So we can see for some of the tanker sectors, some of the LPG and offshore, we're sort of at or near historical highs in today's market. So it's a good market from an earnings perspective for a large chunk of the shipping industry. And here it is, the infamous slide. Where are we on the earnings cycle? I thought I'd get this one out the way quickly. Things haven't changed too much from 12 months ago in some respect. We still have a lot of sectors on the left-hand side. That's fundamentally, the fundamentals are still strong here. Earnings are still high. They've just come off a little bit from the sort of the frothy levels perhaps we've seen over the last 12 to 18 months. LNG, I would say, has moved down. We've seen earnings here half over the course of the last 12 months. Now on the right-hand side, we can see offshore. 12 months ago, I said that offshore still had a long runway to go in terms of earnings and improvements in earnings, and it continues to improve, and we still think there's some distance still to go. Car carriers are stubbornly at the very top of the market. They refuse to sort of come off the highs that we've seen over the course of the last 12 months. And I guess the interesting sector that has sort of moved from the left to the right is the container ship sector. Now, we were forecasting demand on the container ships to be relatively strong this year, but what we have seen, as Doug has already sort of alluded to, is a number of events that have helped push the container ship market and a lot of other markets up higher. So I thought I would just spend 3 slides just talking about events. And obviously, when we talk about events, we're imminently starting to talk about things like black swans. I thought I'd have a look on Google Trends. I've not used it before, but I found out about Google Trends. Google Trends just tells you how often search words are put into Google. I put in black swan event, and you can see over the course of the last 5 years, there's been an almost exponential increase in the number of times that search phrase has been used on Google. So we are in sort of an unprecedented era currently for black swan events. And if we sort of translate that to shipping a little bit more specifically, I thought I'd put up the BDI and just went back through my own sort of memory bank to see what had happened. I sort of joined shipping in 2002, so I sort of witnessed most of this. This is just the BDI. There's been a lot of instances, black swan events that help drive the market. Now, what I would say with shipping and events is that shipping always does well in events, these sort of black swan events, and it always manages to adapt, I think, is probably the phrase. What we can see from the little table on the top left is a volatility measure. Volatility for the BDI has been greater in the last 5 years than it was in the previous decade, and even in that first decade of this century when we saw the super boom. So we really are in a period of heightened volatility. And unfortunately, or fortunately, depending on what side of the coin you're looking at, that volatility I don't think is going to go anywhere anytime soon. We've got half of the world's population going to the polls this year. There's bound to be more unrest, more trade, more taxes on trade, etc. over the course of the next 12 to 24 months. And then I had a look at the World Economic Forum and their recent survey where they looked 2 years out and 10 years out to look at global risks. And as you can see, I think it's quite worrying, really. In 10 years' time, over 2/3 of the survey respondents thought that the economy would be in turbulent or stormy environment. So certainly more risks, more black swans, more volatility around the corner. So what I want to do now is just sort of do a bit of more of a deeper dive into the demand side of the market. Start off just by looking at a headline cargo growth, both last year and this year, and compared it to the historical 10-year averages. Now, last year we saw positive cargo growth across all sectors bar containers. This year we can see the yellow bars are all in positive territory, and in a large number of instances are above that 10-year historical average. So, yes, cargo growth has continued to be relatively bullish this year and potentially beyond. Now, if we start looking at how some of the events have shaped the markets, and obviously there are a lot of events, so I've just highlighted and picked out a few. Starting off on dry bulk, China, of course, remains a dominant player when it comes to dry bulk. We can see the chart in the top left, which is coal stockpiles. During last year, there were droughts within China that reduced hydroelectricity production in China, and coal was the replacement energy form. We saw huge stocks build up, and those stocks of coal have remained at very near record high levels. That's also been helped more recently by a drop in the coal price. So there we have an event that sort of changed the dynamics in the dry bulk industry over the course of the summer last year. At the same time, a lot of us has been looking towards the Chinese government to inject stimulus into the sort of construction industry within China. But as we can see from the chart on the bottom left, cement imports, which are potentially a good indicator of that construction, have been very low over the course of the last 2 years. So China is sort of playing ball on one side and importing, and on the flip side, we're seeing some cutbacks in some of the construction materials. But as we can see from the chart on the right, which is incremental seaborne trade, we're relatively positive for the next few years for dry bulk. As we move into the second half of the decade, the growth will, we think, however, come from grains and will come from minor bulks. On the oil tanker side, the chart on the top left, we can see the impact of China lifting zero COVID policy. We saw double-digit growth of oil demand in China last year. And again, that's a policy, that's an event that has helped drive the markets. At the same time, at the bottom left chart, we can see another policy that's impacted the market, and that's the OPEC plus cuts that have been in place over the course of the last couple of years, whereas here in the US and North America, we've seen increased oil production, again, helping shape the market, increasing ton miles. So we can see from the chart on the right, we do expect to see incremental seaborne trade in the oil tanker markets for the next few years. For containers, as I said, we were forecasting an increase in trade. We've seen the Asia-Europe trade come back to sort of those COVID levels. We've not quite seen that on the Trans-Pacific. I think the interesting thing on containers is the growth that we're now seeing on some of the minor trades, the north-south, the non-main lane trades. I've put up here Chinese exports of manufactured goods to Mexico and Brazil. There's an element of here of what we're now talking about, sort of the near-shoring, the friendly shoring, with goods being imported to Mexico or semi-processed goods imported to Mexico and then either shipped, railed or trucked up to the US. There's also an element of China trying to export some of the goods it can't consume domestically to developing countries. But we can see on the chart on the right, containers is set for another 3 years at least of strong growth. We think about 4.5% year-on-year incremental container trade out to the middle of the decade. So what we've seen with a number of these events are changes to vessel operations and vessel efficiencies. And that's really what's helped drive the markets to some of the levels that we've seen recently. As we've mentioned, if we think since COVID, there have been two, I would say, big sort of mega black swans. One has been the Russian invasion of Ukraine, and the movement of oil from Russia, rather than it going to Europe, is now heading further east. Crude oil going east typically to India, to China, and then we've got the product trade going the other way, either from India, China, or the Middle East, going back to Europe or the Atlantic Basin. So that's had a huge impact on the oil tanker market. And the chart on the right shows LNG. We've seen a lot of changes in LNG developments. A lot of US LNG exports that were going to Asia started going to Europe over the course of 2002, 2023 to replace lost Russian pipeline gas. But we can see that that's sort of starting to unravel over the course of this year. The big events over the last 12 months, of course, have been canals. Now, there's been the Panama Canal and the droughts that we've seen there, but of course, we've also seen the events in and around the Red Sea and the Suez Canal. And I think it's very dependent on whether vessels are rerouting around the Cape of Good Hope. It's very much dependent on the sector. It's also dependent on the owner and the operator. These are just some charts from our heat maps from our AAS analysis. So we can see the changing trade routes in the first half of last year versus the first 6 months of this year. And things have changed significantly, certainly over, if you look at West Africa. But we can see certainly for LR1s, LR2s and Suezmaxes, we're still seeing some cargoes going through the Suez Canal. That rerouting is having a huge impact on ton miles. Let's just concentrate on crude oil because I think that there's a good story to be told just by looking at that chart. We can see our view of tons, so that's cargo on the water. 2024, we think that that will grow by about 1%. If we start factoring in the impact for ton mile growth this year will be closer to 7.5%. And that's baking in what's happening in Russia, the deviations also around the Capes. So that's having a huge impact on supply-demand fundamentals. Where we've perhaps seen the most deviation around the Cape has been on the container ship sector. And of course, this is coming at a year when we're seeing record deliveries of new vessels coming out of the yards. Now, it's almost a coincidence that those new vessels that have come out the yard almost exactly meet the new requirements that we need for the industry to meet the sort of the weekly liner scheduling services for vessels trading from the east to west. And we can see that the built-up of the stack bar in the chart on the left. The dark blue is new tonnage coming into the market this year, and the yellow is incremental tonnage that's been required through deviations and the incremental container growth in trade. What we're now seeing in containers as well, as we saw during COVID, is a build-up in port congestion. And we all remember how much that really impacted the markets, especially here in the US, in Long Beach and LA, with queues that were going 60 kilometers out to sea. That can really start changing the dynamics of the container industry pretty much overnight, and we're starting to see a solid build-up in port congestion. I thought I would just spend 3 slides talking about a little bit longer out some of the structural demand shifts that we expect to see. And I thought I would start off with China. I mean, China has been the sort of go-to for any analyst over the course of the last 20 years to try and identify where growth is coming from. We are seeing a slowdown in some of the Chinese imports and exports, and that's only natural. The economy is maturing. The urbanization and industrialization of China will plateau potentially in the next 10 years, and the population is now shrinking. I think the important thing to say is China is slowing. It has been slowing for some time, but there's still growth remains in China, just not at those potential double-digit levels that we've seen historically. There are new sources of demand. India is, of course, one that a lot of people look towards with the growing population, now the largest, most populous country in the world. And we can see from the 2 charts on the top left here, incremental coal imports and crude volumes. South Asia, we expect to see growing for some time to come as we move out to the middle of this century. And not only are we looking at new sources, not new countries in terms of demand, we're also looking at new cargoes. The bottom 2 charts show 2 new cargoes that the industry hasn't really had to deal with in the past and present an opportunity for shipping. One is the transition to green steel. Green steel requires HBI and DRI. We're not seeing hardly any of this being shipped at the minute, but as you can see, by 2050, based on our forecast, we're going to need to be shipping around 120 million tons of these products around the world to service green steel production. And of course, clean methanol and clean ammonia. There's no trade in this currently, but as we can see, by 2050, we're expecting to see around 300 million tons of these two commodities combined traded globally. A new opportunity for shipping, one that shipping hasn't overlooked. We're now seeing over 60 very large ammonia carriers on the order book to potentially help with some of this incremental trade developments. Looking further afield, we have to start thinking about the energy transition. I think the only thing I want to say about the energy transition and the point to take from these two slides is that I would say that we're sort of in that transitional period now. Up until sort of the last 5 years, things have still been growing in terms of hydrocarbon shipping. I think as we look towards the back end of this decade, things will start slowing somewhat. And as we can see, as we move to the middle of the decade, from the MSI energy model, we'll start seeing a reduction in things like coal trade. I can't do a fundamentals and not talk about supply at all. Contracting over the course of the last couple of quarters has been robust. It hasn't been as strong as it was in the first half of last year, but we've certainly seen an increase in orders for things like tankers, and there are still a lot of orders that are rumoured that haven't perhaps made it onto the order books, certainly things like containers. I think some of the orders are needed if we look at the age profile of the fleet, and what I've done on the chart on the right is look at the order book as a percentage of those fleets over 15 years old. We can see where there's potentially overexposure to the order book, highlighted in red, and underexposure highlighted in blue. And you can see there's a lot more blue than there's red or amber. So we do need incremental new tonnage to be ordered. I think we just have to be careful in what sectors we're ordering it in. We're still seeing the transition towards decarbonisation, the transition to dual fuels. If we look at container contracting by fuel type and the chart on the left, we can see over the course of this year, every single vessel has been ordered with a dual fuel capability. That hasn't happened so far in dry bulk and oil tankers. It's slowly moving there. The reasons for this are well documented versus containers. Containers are obviously close to the end consumer. They've been sitting on piles of cash. They can cope with the extra capex. They're on a liner service for the majority of the time. They can start trying to secure fuel at either end. And of course, containers and car carriers, I would say, where we're also seeing this trend, are the sectors that are probably going to be, and are being the most exposed to the European ETS and also fuel EU. So it makes a huge amount of sense to be sort of looking at dual fuel for vessels trading into Europe over the course of the next 5 years. That's not to say that we don't think that oil tankers and dry bulk will start moving down the line of using additional green or cleaner fuels. This comes from our forecast of marine bunker consumption. And as you can see, the transition isn't ubiquitous across all sectors. And by 2050, we do still think that there'll be some oil derivative cargoes being used. So we do think that carbon capture will play a part here if the IMO's 2050 trajectories are going to be met. Another interesting development that we do expect to see is an increase in retrofits and an increase in energy-saving technologies being deployed on vessels. This will obviously help prolong the life of some vessels. What will also happen is that the fleet will become more inefficient. As we saw when scrubbers were fitted in 2019, it takes longer to fit these retrofits or the ESTs, so we'll be removing supply from the system, which will actually be a positive for the markets. And to finally end up on talking a little bit about earnings and values, new building prices, a lot of the inflationary pressures that we've seen in new building prices over the course of the last couple of years have come off a little. We can see the chart on the left, which is steel plate price and iron ore price. Still very high, I might add, steel plate, around $600 per tonne, but nowhere near the $1,000 per tonne that we saw a couple of years ago. We do think that new building prices will come off towards the very back end of this year and into next year. And as you can see from the chart on the right, which is the red line, it's only going to sort of marginally come down. It's not going to be a collapse in new building price. The reason we say this is because we do think that there will be more deliveries than new orders over the course of the next 2 years. And as we can see from the bars and the relationship between the bars, which is the net of contract minus deliveries, and the new build price, there's a good relationship between the two. Earnings, as we look out on the chart on the left, they will remain relatively robust for the next 3 years. We will see a slight softening for some sectors, but generally we still remain relatively positive on earnings, especially if we compare it to averages over the last sort of 14 years. One sector we do think there needs to be something of a realignment is the dry bulk sector. So the chart on the right just shows you the ratio of net earnings versus 5-year-old prices. And you can see at the minute the dry bulk sector is a long way above all other sectors. So we either need to see earnings increase in dry bulk to support those ratios, or prices come down, or a meeting in the middle. But we don't think that these sort of ratios are sustainable for a sustained period. We can see that there has been some drop. We just think there's further drop to go. So second-hand prices, we do think, will slide as we move out over the next 4 years. This is just a price distribution chart over history. We can see the yellow bars where prices are today. The red bar shows you where we think prices will be by the end of 2008. Even though the red bars sort of shift to the left, the one thing I would say is that the red bars, pretty much in all instances, bar one, remain above the median and the mean across history. So from that perspective, it still remains relatively positive. And finally, as I always like to do here at Marine Money New York, is just to sort of run a large number of vessels through the MSI's models and try and pick out, based on our forecast, where we think the current opportunities are from an asset value perspective and a net earnings perspective. And you can see that there are still opportunities in shipping, although we are potentially at the peak of the market from an asset price and an earnings perspective for a large number of sectors. We are still forecasting some sort of sterling sort of high single digits and some double-digit IRR returns over the course of the next 5 years for both 10-year-olds and 5-year-olds. But the standout still remains the offshore sector. We do still think that the best returns in the maritime sector remain in offshore. So I appreciate I've just run a little bit over time, but thank you everyone very much for your time. Tongue-tied,